$7.6 trillion. That is the amount of United States Treasury debt currently held by foreign governments and institutions across the world. That number is not just a statistic on a government spreadsheet. It is the foundation stone of the entire modern financial system. Every pension fund, central bank, and sovereign wealth fund treats those assets as the ultimate safe harbor of global finance. But over the past few years, a quiet shift has begun that is forcing serious analysts to ask a dangerous question. What happens if the institutions holding those trillions start believing that safe harbor is no longer politically neutral? The story unfolding right now is not about one headline or one speech. It is about the slow transformation of the dollar itself into a geopolitical instrument. Picture the scene inside a central bank dealing room. Screens glow with currency pairs updating every fraction of a second. Government bond yields move in tiny increments that determine the cost of mortgages, business loans, and infrastructure across continents. Traders are not arguing about ideology or domestic politics. They are measuring risk with mathematics. For decades, one assumption sat quietly inside every risk model. Assets held inside the United States financial system would remain accessible regardless of diplomatic disputes. That assumption allowed the dollar to dominate global trade, global reserves, and global banking. But the past decade introduced something different into that equation. Governments watched the United States deploy financial sanctions with increasing reach and precision. Those sanctions were not theoretical. In 2014, after the annexation of Crimea, the United States and its allies imposed sweeping financial restrictions on Russian institutions. In 2022, that strategy escalated dramatically when Western governments froze roughly $300 billion of Russian central bank reserves held abroad after the invasion of Ukraine. That moment produced immediate geopolitical consequences far beyond the battlefield. Central banks across Asia, the Middle East, and Latin America began reassessing exactly where their reserves were stored and in what currency they were denominated. For many officials, the lesson was simple but unsettling. If geopolitical tensions escalate, financial infrastructure itself can become a pressure tool. That shift did not stay inside diplomatic briefings. It began appearing in hard numbers inside international reserve data published by the International Monetary Fund. 2 decades ago, roughly 70% of global foreign exchange reserves were held in U.S. dollars. Today, that share has slipped closer to 58%, according to widely reported IMF data. The dollar remains overwhelmingly dominant, but the direction of travel is unmistakable. Several large economies have been slowly diversifying reserves into euros, yen, gold, and increasingly into domestic currencies for bilateral trade. None of this happened overnight, and none of it means the dollar is about to collapse. But the trend itself tells you something important about how governments are recalculating risk. There is a specific detail here that almost no coverage led with, and it changes the way the rest of this story lands. The shift did not begin after a single sanction announcement or diplomatic dispute. It began quietly inside trade settlement systems where commodities like oil, gas, and industrial metals are priced and paid for. Historically, those markets run almost entirely through dollar clearing banks located in New York. That arrangement created enormous efficiency because every participant used the same currency and the same payment rails. It also created a single point of leverage inside the global financial architecture. Once that realization spread among finance ministries, alternatives slowly began appearing. Let that sit. Several governments started experimenting with bilateral settlement agreements that bypass traditional dollar clearing. China and Brazil announced a framework allowing some trade to settle directly in yuan and reais. India and the United Arab Emirates tested mechanisms for rupee settlement and energy trade. Even within Europe, discussions intensified around strengthening euro-based commodity contracts. None of these systems are large enough to replace the dollar, and most analysts agree that transition would take decades if it happens at all. But the experiments themselves reveal something about the psychology of global finance. When institutions perceive a structural risk, they begin building backup systems long before that risk becomes urgent. Those numbers do not stay abstract for long. When global reserve managers rebalance even a small percentage of their portfolios, it can move hundreds of billions of dollars between markets. That movement influences interest rates, currency strength, and the cost of borrowing for governments. The United States currently runs large fiscal deficits financed partly through international demand for Treasury bonds. As long as those bonds remain the safest and most liquid asset on Earth, the system functions smoothly. But if confidence gradually shifts, borrowing costs could drift higher over time. That possibility is exactly what analysts inside the Federal Reserve and Treasury Department quietly monitor. Picture this. It is late evening inside a finance ministry somewhere in Asia. Analysts are preparing a reserve allocation report for the next fiscal year. On one screen, they see the yield on U.S. Treasuries, historically stable and extremely liquid. On another screen, they see recent headlines describing sanctions and asset freezes used as geopolitical tools. The question in that room is not ideological or emotional. The question is mathematical risk management. If reserves exist to protect national stability during crises, or should they be stored to guarantee access? That single calculation is repeating inside dozens of institutions across the world. But that is only the surface layer of what changed. Behind those reserve calculations sits a deeper system that most households never think about until something breaks. The global payments network known as SWIFT connects thousands of banks across 200 countries. When sanctions remove a bank from that network, it can suddenly struggle to process international transactions. That capability has become one of the most powerful non-military tools available to governments. It allows financial pressure without traditional warfare. At the same time, it reminds every other government participating in the system that access depends on political alignment with the countries controlling those mechanisms. That tension produced a predictable response. Russia accelerated development of its domestic financial messaging system after facing sanctions in 2014. China expanded its cross-border interbank payment system designed to facilitate yuan settlements. Regional trade groups began studying how to maintain payment flows even during geopolitical disputes. These projects remain far smaller than the existing Western infrastructure. But they exist, and they are expanding slowly every year. The presence of alternatives changes how participants think about long-term financial strategy. The next data release on global reserve composition will arrive later this year. Based on everything you have heard so far, drop your prediction below. Do you think the dollar share rises again or continues drifting downward? Analysts watching these numbers know that even a 1% shift represents hundreds of billions moving across borders. And those movements rarely reverse quickly once they begin. Reserve managers prefer stability, not dramatic reallocations every year. That cautious behavior means small trends can quietly compound over time. And the situation did not stop there. Energy markets introduced another layer of complexity into this evolving financial landscape. For decades, most international oil contracts have been priced in dollars, a system sometimes called the petrodollar framework. That arrangement reinforced dollar demand because countries needed dollar reserves to purchase energy imports. Recently, a handful of producers began accepting alternative currencies in limited circumstances. China has encouraged settlement of some energy purchases in yuan through Shanghai-based futures contracts. The volumes remain relatively small compared to global oil trade. But again, the direction of experimentation matters more than the size of the initial step. That shift matters because energy prices feed directly into household budgets everywhere. When currency relationships change, exchange rates can influence the cost of fuel imports. Higher energy costs ripple through transportation, agriculture, and manufacturing. The result eventually appears in grocery store prices and heating bills. What begins as a technical adjustment inside commodity contracts can end up affecting everyday expenses for millions of families. Financial infrastructure might look abstract, but its consequences always arrive at kitchen tables. There is still another layer beneath all of this, and it explains why central banks treat the issue with such caution. The dollar dominates global finance not only because of American economic size, but because of deep, liquid capital markets. Investors can buy and sell trillions of dollars in U.S. Treasury securities without disrupting prices significantly. No other market currently matches that scale or transparency. That liquidity acts like the plumbing of the entire system. Changing it requires building equally deep alternatives, something that cannot happen overnight. But the signal remains visible. Governments are studying redundancy the same way engineers design backup systems for power grids. The idea is not to abandon the existing structure tomorrow morning. The idea is to ensure options exist if geopolitical conditions deteriorate. In risk management language, this is called hedging exposure. In geopolitical language, it is sometimes described as financial sovereignty. The motivations overlap even when the political narratives differ. And that quiet preparation is exactly what makes this story so important to watch. Those quiet preparations matter because the financial system rarely breaks in dramatic single moments. More often, it shifts through dozens of small adjustments that compound over time. Reserve managers change allocation targets by a fraction of a percent. Commodity contracts add optional settlement currencies. Regional banks experiment with new clearing channels for cross-border payments. Each move alone looks technical and minor, almost invisible outside specialist circles. But when analysts line those decisions up across several years, a pattern begins to emerge. The global system is slowly testing how dependent it truly needs to be on a single financial architecture. That pattern became impossible to ignore after the 2022 sanctions on Russia froze a large share of its central bank reserves. The move was coordinated among the United States, the European Union, the United Kingdom, Canada, and Japan. Financial authorities around the world studied the decision carefully because it demonstrated how reserve assets held abroad could become inaccessible during geopolitical conflict. The policy had clear strategic goals connected to the war in Ukraine, but it also forced reserve managers everywhere to reconsider a basic assumption about financial neutrality. Assets inside foreign jurisdictions carry political risk during extreme circumstances. Read that again. For many finance ministries, the response was not to abandon the dollar system immediately. That would be unrealistic given the scale of global markets. Instead, the response looked more like diversification. Gold purchases by central banks surged in 2022 and 2023 to the highest levels in decades, according to data from the World Gold Council. Several emerging market economies increased holdings specifically because gold sits outside any single national jurisdiction. It cannot be frozen through foreign banking systems in the same way electronic reserves can. That characteristic gives policymakers a form of insurance when geopolitical tensions rise. But gold alone cannot power the modern financial system. International trade requires fast digital settlement through banks and clearinghouses. That reality pushed governments to explore alternative payment channels alongside traditional ones. China expanded its cross-border interbank payment system, often called CIPS, which allows international transactions denominated in yuan. India introduced mechanisms for rupee settlement in certain bilateral trade agreements. Even European officials have debated strengthening euro-based energy trading infrastructure to increase financial autonomy. None of these efforts currently challenge the scale of dollar clearing networks. Yet together they reveal a strategic theme: redundancy. Picture this. You are inside a large sovereign wealth fund managing hundreds of billions in assets. Your mandate is not politics or diplomacy, but long-term stability. You watch reserve statistics shift gradually while alternative settlement systems expand year by year. At the same time, you see geopolitical tensions intensifying between major powers. The logical response is not panic or sudden withdrawal from established markets. The logical response is to ensure multiple channels remain available if conditions change quickly. That calculation is now happening simultaneously across dozens of institutions responsible for global financial stability. And that is still not the deepest part of this story. Energy markets quietly amplified these trends in ways that reach directly into household economics. Oil remains the most traded commodity on Earth, and its pricing structure historically reinforced dollar demand worldwide. Countries imported crude oil using dollar reserves, which reinforced the currency's central role in global finance. Recently, several producers signaled willingness to accept alternative currencies under certain circumstances. China has encouraged settlement of some energy purchases in yuan through futures contracts traded in Shanghai. India has discussed rupee-based settlements with a handful of partners. The volumes remain small relative to the full oil market, but the symbolism matters. That symbolism matters because energy trade creates constant demand for settlement currency. When a refinery purchases crude oil shipments every month, it must hold reserves in the currency used to pay for those contracts. If even a small portion of global oil trade begins using multiple currencies, the structure of reserve management gradually adapts. Central banks diversify not out of hostility, but out of operational necessity. A refinery cannot pay for cargo in euros if the central bank holds only dollars. Over time, that logistical requirement encourages broader currency portfolios. But those adjustments also collide with another reality inside the U.S. financial system. The American government currently carries more than $34 trillion in national debt, according to the Treasury Department. Financing that debt depends partly on strong demand for Treasury bonds from global investors. Those bonds remain one of the safest and most liquid assets ever created. Yet the scale of borrowing means even modest changes in demand can influence interest rates. When global reserve managers diversify portfolios slowly, yields sometimes drift upward as markets absorb the shift. If you saw these signals building before the headlines intensified, how long ago did you start watching this develop? Let me know below. For households, the connection might seem distant, but the transmission channel is straightforward. Treasury yields influence mortgage rates, auto loans, and credit card interest across the economy. When borrowing costs rise even slightly, monthly payments follow. That pressure eventually appears in housing markets, construction activity, and consumer spending patterns. Financial architecture that once looked like a purely diplomatic issue suddenly becomes a kitchen table calculation for millions of families. The global reserve system might feel abstract until the mortgage payment changes. Let that sit. The next layer emerges when you examine how central banks respond to these structural signals. The Federal Reserve does not control global reserve allocation, but it closely monitors international demand for U.S. assets. When demand weakens, financial conditions tighten as yields rise. The central bank may respond by adjusting interest rate policy to stabilize economic growth and inflation. Those policy moves ripple through financial markets worldwide because the U.S. dollar remains the dominant currency in international lending. When American interest rates shift, capital flows adjust across emerging markets and developed economies simultaneously. But the system's resilience also comes from deep institutional trust built over decades. Investors know that U.S. financial markets operate under transparent rules, independent courts, and extensive regulatory oversight. That credibility supports the dollar's role even when geopolitical tensions intensify. Many economists argue that no realistic alternative currently offers the same combination of liquidity, legal protection, and market depth. That is why the dollar still accounts for the majority of global reserves despite gradual diversification. Structural dominance does not disappear quickly. The contradiction appears when political pressures intersect with that institutional trust. Governments increasingly use financial tools to pursue strategic goals, from sanctions enforcement to export controls and technology restrictions. Each action may be justified within a specific policy framework. Yet collectively, they reinforce the perception that financial infrastructure is becoming part of geopolitical competition. When that perception spreads, risk managers inside global institutions begin recalculating exposure. Not because the system is collapsing, but because prudent strategy requires preparing for multiple scenarios. And that calculation is accelerating faster than most public coverage suggests. Analysts studying reserve trends often highlight a subtle but important detail in the data. The decline in the dollar's share of reserves has not been matched by a single replacement currency. Instead, reserves are spreading across several alternatives, including the euro, the yen, the yuan, and increased gold holdings. That fragmentation means the global system may become more multipolar rather than simply switching from one dominant currency to another. Multipolar financial systems behave differently during crises because liquidity spreads across several hubs instead of one. Those numbers do not stay inside economic textbooks. They influence how governments respond when financial shocks appear. During the global financial crisis of 2008, the Federal Reserve established emergency currency swap lines with several major central banks to stabilize dollar funding markets. That action reinforced confidence because institutions trusted the United States to provide liquidity during extreme stress. Future crises could test whether that trust remains equally strong as geopolitical tensions rise. The answer will shape how the next generation of financial infrastructure evolves. Those liquidity backstops from the Federal Reserve during the 2008 financial crisis still echo through policy discussions today. Central banks remember that moment because dollar funding markets nearly froze before emergency swap lines restored stability. The lesson was simple but powerful. The global economy relies heavily on the plumbing of dollar liquidity when stress spreads across financial systems. That dependence is precisely why diversification discussions have intensified among policymakers over the last decade. They are not trying to dismantle the existing system tomorrow morning, but they are asking whether relying on a single pipeline creates vulnerabilities during geopolitical shocks. This is where the story reaches the point most public coverage rarely explores. The global financial order was designed during an era when economic integration expanded faster than geopolitical rivalry. Trade agreements multiplied, capital moved across borders with fewer restrictions, and financial institutions assumed stability would continue indefinitely. Over the last several years, that assumption has begun to erode under pressure from strategic competition between major powers. Technology restrictions, export controls, sanctions regimes, and supply chain reshoring have become regular policy tools. Each measure individually serves a specific national interest, yet together they signal a more fragmented economic environment. But that fragmentation carries consequences beyond diplomacy or trade statistics. International capital markets depend on predictability, not just profitability. Investors allocate trillions of dollars across borders based on confidence that contracts will remain enforceable and assets accessible even when political relationships become tense. When governments demonstrate the ability to restrict financial access as a policy tool, investors naturally begin studying how exposed they might be. That process does not require hostility toward any country. It is the same risk management instinct that drives insurance companies to model rare disasters. Picture this. It is early morning inside a major pension fund responsible for millions of retirement accounts. Analysts review global bond markets while scanning geopolitical headlines. They see Treasury yields adjusting as international demand shifts by fractions of a percent. They also see foreign central banks increasing gold purchases and exploring non-dollar settlement options. The pension fund will not abandon U.S. markets because those markets remain the deepest and most liquid on Earth. But the analysts quietly adjust risk models to account for a world where financial systems might fragment along geopolitical lines. That moment connects directly to something mentioned earlier, but not fully explained. Early in this discussion, you heard about experiments in alternative settlement systems for commodities and bilateral trade. At first glance, those projects looked technical and limited in scope. Yet their real significance appears when financial stress intersects with geopolitical tension. If multiple payment channels already exist before a crisis begins, governments and corporations have options when traditional routes face restrictions. Building redundancy during calm periods is far easier than constructing new systems during emergencies. That is the detail planted earlier that changes the rest of the story. Read that again. The presence of backup systems does not automatically weaken the dollar or dismantle existing financial architecture. Instead, it changes the strategic landscape by reducing the cost of experimentation. Countries that once depended entirely on one clearing network can test alternatives without risking complete disruption to trade flows. Over time, those experiments accumulate data, infrastructure, and institutional familiarity. When enough participants understand how alternative rails operate, switching between them becomes technically easier. That gradual learning curve is how major structural transitions often unfold. You are watching this calculation unfold in real time before most people have connected these dots. For households, the implications appear slowly but persistently through financial conditions. When global demand for dollar assets shifts even modestly, U.S. interest rates respond through market forces. Higher yields eventually translate into higher borrowing costs for mortgages, credit cards, and business loans. Those costs shape housing markets, employment decisions, and consumer spending across the economy. The infrastructure of global finance might seem distant until it reaches the monthly budget. But there is another layer unfolding simultaneously inside global energy markets. Several oil producers and large importers have discussed expanding the currencies used for settlement in certain contracts. Again, the volumes remain limited compared with total global oil trade. Yet the symbolism resonates with policymakers. Energy is the lifeblood of industrial economies, and the currency used to price it influences reserve management everywhere. If more contracts accept multiple currencies, central banks adjust holdings to match those payment needs. The system evolves not through dramatic announcements, but through operational logistics. That evolution also intersects with the rapid rise of digital financial technology. Central banks are experimenting with digital currencies that could settle cross-border transactions faster than traditional banking rails. China's digital yuan pilot has already processed billions in domestic transactions while exploring international applications. The European Central Bank continues studying a potential digital euro. Even the Federal Reserve has researched digital payment infrastructure without committing to issuing a digital dollar. These technologies could eventually reshape how cross-border payments operate if they scale successfully. Let that sit. Now place two official positions side by side. One narrative argues the dollar's dominance remains secure for decades because no rival currency offers comparable liquidity and institutional trust. Another narrative warns that geopolitical fragmentation and financial weaponization could gradually erode that dominance over time. Both positions rely on real data and credible analysis. Yet both cannot fully describe the future simultaneously. Which version reflects what you are actually seeing in the numbers and policy signals around the world, and why? The tension between those interpretations explains why central banks are moving cautiously rather than dramatically. Abrupt changes in reserve allocation could destabilize markets and damage the very economies policymakers are trying to protect. Gradual diversification, however, allows institutions to adapt quietly while preserving stability. This is why the dollar's share of global reserves declines slowly instead of collapsing suddenly. Structural systems built over 70 years rarely change through overnight revolutions. They evolve through long cycles of adaptation.